Hey, my name is Devin Watts, and my partner Ryan Pasalakis and I did our first Finance 139 case analysis on two healthcare providers, Aetna Incorporation and Cigna Corporation. I'll go over those right now. So Aetna, founded in 1853, their current market value is $57 billion as of February 9th, 2018. And as of late 2017, CVS Healthcare, or Health Corporation, announced that they were going to acquire Aetna. The Cigna Corporation, our second company, is another healthcare provider founded in 1792, and their current market value is $47 billion as of February 9th, 2018. Now I'll go ahead and bring up my partner Ryan to talk about why investors care about their cost of capital.
Investors care about cost of capital since the required rate of return is their return on their initial investment, and also a shareholder must consider if the company is operating at optimal mix of debt and equity to minimize their risk. Furthermore, the tax rate and spread must be considered. For cost of debt financing, both Cigna and Aetna have a AA rating, which constitutes a spread of 0.72%. We also used a risk-free rate of 4%. Therefore, both companies' pre-tax is 4.72%. Aetna had a slightly lower after-tax cost of debt due to the higher effective tax rate.
The next question in this analysis is, what is our cost of equity financing? And another way to ask this question might be, what is our expected return on the investment? Because once we find the expected return on the investment, then we have found our cost of equity financing. And some assumptions we made in this analysis were the market risk premium. And the market risk premium was found using the S&P 500 returns over the years of 1960 to 2017. We then took the geometric mean of those returns from those years and plugged it into the equation. Another assumption was the risk-free rate, which was given to us by the Treasury bond at 4%. And from there, we calculated the beta of both our companies and plugged it into the equation. So the equation goes for Aetna, 4% risk-free rate, a beta of 0.81, a market risk premium of 6.24% minus the risk-free rate of 4%, which gave Aetna the cost of equity financing, or expected return, of 5.82%. And then for Cigna, we did the same thing, risk-free rate of 4%, and then the beta calculated out to 0.71, and then the market risk premium of 6.24%, and then minus the risk-free rate of 4%, which gave Cigna the cost of equity financing 5.58%. Next, what is our overall cost of capital? For this, we use the weighted average cost of capital calculation. In order to find that, we used the equity ratio and debt ratio, along with the cost of debt and cost of equity for both companies. Neither company had preferred stock, so there was no cost of preferred stock, which led us to find Aetna had a cost of capital of 36% and Cigna with a 45% cost of capital. Now that we've found the weighted average cost of capital for both Aetna and Cigna, and again, those numbers were Aetna with a cost of capital of 36% and Cigna with 45% cost of capital, we looked to Professor DeModron's optimal capital structure spreadsheet to find what could we do to lower our capital structure or lower our cost of capital. And so changes to the capital structure would include increases in both the optimal debt ratio and as well as the optimal cost of equity. For the optimal debt ratio, which would allow us to lower our cost of capital, for Aetna, their cost of debt would increase to 16.53%, and for Cigna, their cost of debt would increase by 30.76%. The optimal cost of equity for Aetna would increase by 0.45%, and for Cigna, 0.24%. After both of those have taken place, these changes would bring a higher cost of debt and an increased beta for both firms. However, the cost of capital would be reduced by 0.32% for Aetna and a decrease of 0.15% for Cigna.
Based on our results that Devin had discussed previously, financial restructuring is needed for both companies, Cigna and Aetna. Cigna is operating at a 9.24% current debt ratio, which can be increased to 40%, while Aetna is operating at a current debt ratio of 13.47%, and that can be increased to 30%. If Aetna were to consider this, they would increase their enterprise value by $6 billion. So their shareholders would be happy since they would get an extra $20 increase per share. Cigna would increase $600 million. So furthermore, usually debt can create unnecessary risk, but since companies like Cigna and Aetna both have relatively high effective tax rates, they will actually see a bigger tax benefit by considering more debt. Also, you must consider, though, that their bond rating might decrease when doing so. The disadvantages of carrying more debt is if a company's cash flows are inconsistent, it can become harder to pay off their debt. What do our competitors do? Well, Aetna and Cigna are part of the market specialist sector, so Anthem and United Health Group are also a part of this sector, United Health being the biggest. So Aetna was really the only one that had more cash than the other companies, which would then constitute a low long-term asset percentage, 66.24%.